When war breaks out in the Middle East, most people expect one thing: gold should explode. But this time, that's not what happened. Yes, gold reacted. Yes, oil jumped. Yes, fear hit the market. But the real winner, at least at first, was the US dollar. And that creates a much bigger question. If gold is the ultimate safe haven, why does money still run to the dollar first? Because this is not just a story about gold, it's a story about how fear actually moves through the financial system. The dollar protects you when markets panic, but gold protects you when the system itself becomes the risk. Most people think gold and the dollar do the same job. They don't. One wins the first phase of a crisis. The other wins the deeper phase, when confidence starts shifting under the surface. If you miss that, you misunderstand the markets. Because what's happening in gold, oil, and the dollar is not random, it's a stress test of the entire global financial order. Here's the core framework. The dollar's strength is liquidity. Gold's strength is independence. That explains almost everything. When investors panic, they don't first ask, what is the purest store of value? They ask, where can I move capital fast? That is where the dollar dominates. The US Treasury market remains the deepest and most liquid pool of capital on Earth. Gold works differently. Gold does not depend on a government promise. It sits outside the architecture of fiat money. So, in simple terms, the dollar is the market's first escape hatch. Gold is the system's insurance policy. And recent events in the Middle East gave us a perfect live example. As the Iran conflict escalated, markets followed a script. Oil moved first, then capital rotated toward the dollar, not because the US system is flawless, but because of liquidity. In the opening stage of a geopolitical shock, liquidity beats philosophy. That's the part many retail investors miss. In the early hours of fear, markets do not reward ideological purity. They reward scale, speed, and familiarity. The dollar owns all three. But here's where the analysis gets interesting. Short-term liquidity and long-term confidence are not the same thing. The World Gold Council recently noted, the dollar's resilience can hide slower structural pressures building underneath. The real question is, what happens over the next 5 years if the world becomes more fragmented, more indebted, and more weaponized? For over a decade, U.S. assets benefited from deep markets and institutional credibility. Owning America often meant winning twice. But that advantage is not guaranteed. As other regions improve, you don't need the world to abandon the US just to become less enthusiastic. That is how currency regimes begin to shift, slowly, then suddenly. Portfolio flows begin to reinforce the move. Now add geopolitics. The freezing of Russian central bank reserves was a turning point. Financial assets became geopolitical instruments. It raises a deeply uncomfortable question. What portion of your national savings is truly outside someone else's political reach? And that is exactly where gold re-enters the conversation. Gold does not depend on another state's promise. That's why central banks remain major buyers. They bought 863 tons in 2025. That is not a fringe signal. That's the official sector quietly saying, we want exposure to the dollar system, but we no longer want all our safety to depend on it. The dollar protects against a funding shock. Gold protects against a confidence shock. The dollar helps when markets freeze. Gold helps when trust erodes. The first market reaction is usually about urgency. The deeper story is about trust. Gold may become more important in this decade. Gold is not really a bet on catastrophe. It is insurance against the possibility that the system itself becomes less neutral and less stable. When the next crisis hits, do you want the first reaction asset, or the one that protects you if the rules change? Subscribe for more breakdowns.